We finally got it. The day that we've been anticipating for quite some time, and it felt like it might not ever come, finally landed in our laps here today. A big sell off in the market. Markets finally responding to yesterday's interest rate decision, and then followed through in the overnight session with a number of other central banks around the world kind of supporting in that effort to get more hawkish. And therefore the markets did tumble. In fact, we lost about $870 billion within assets in the US stock market here today. Only about 6% of the companies in the United States closed higher. So it was an overwhelming day for the bears. So we're going to talk about that in tonight's video, give you a sense of how it has shifted our postures on a number of charts. We're going to look at some macro analysis. We're going to look at some sector analysis. Then we're going to get into a trade application example. As many of you know, I like to find days like today as an opportunity and look to sell puts on high quality dividend stocks when the prices are more attractive as they are today. So we'll do that today on a consumer staple company in our trade application example. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's December 15th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area. Make sure you're signed up for our email distribution list so that way you can see which stocks are giving you overbought and oversold cluster signals within the S&P 500. In addition to being notified whenever these videos have been posted. I imagine there will probably be quite a few oversold cluster signals in tonight's email. In addition to that, we're heavy users of Twitter. If you're not doing so yet, I would encourage you to follow me at Brandon Van Zee. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join us at that group that you see in the web address in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, it was a sea of red. I'm actually going to my son's school Christmas concert tonight, and of course the Christmas colors tend to be red and green, but we're kind of washing that green away in a big way here today. We'd like to see a little bit more balance out there. This was quite the day, one for the ages, as markets responded very powerfully after getting the information regarding the interest rate decision yesterday. Of course, I'm sure you've probably listened to David's presentation already, and he notified you that it was a 50 basis point hike, which was largely expected, but where the stock market was growing a little bit more concerned once again is they were reminded that Chairman Powell has no intention of letting up his battle against inflation. He is going to do the job, or at least that is the message he is sending. And up until yesterday during the press conference, it's possible that the stock market was in la-la land, not really believing him, or perhaps trying to call his bluff. And he wanted to make no bones about it. He's not bluffing. He's going to go and see this job through, no matter what it takes. And so the market started to get a sense that we've got a long road in front of us of continued interest rate hikes, even if they'll be a step down from the more aggressive hikes that we started this campaign off with. They will still be coming for quite some time into 2023. So no Fed pivot on the table. And today we've got the recourse and the reaction to that. The other thing to be aware of is that there was some coordinated action out there from central banks globally, and some of the central banks in Europe and elsewhere also hiked interest rates last night in the overnight cycle, kind of almost in unison or support of what happened here with the Federal Reserve. And so this is not just a U.S. problem when it comes to inflation. This is a global problem, and it seems like most nations are kind of on the same wavelengths from that perspective. So expect some difficult moments moving forward. Earlier this year, Chairman Powell said, expect pain, and I have no reason not to believe him. And today could just be a taste of things to come for a big chunk of next year. So we shall see. Obviously, things can change, and that's why it's important to stay plugged in with these presentations as often as you do. If there is some sort of a major shift, change, or update to the charts or the sentiment of the Fed or some other big geopolitical news event that shapes the market's mindset differently, we'll of course do our best to keep you abreast of that situation. But for right now, it seems like we are back to kind of the status quo of lower highs and lower lows. Remember when we talked about that a week ago or so when we touched 4,100, it was right at the underside of that downward trending trend line that you lay across the tops of those S&P 500 candles. Maybe we can take a look at that a little bit later when we're looking at our charts as well. But we are still kind of in that mode of lower highs and lower lows. And some of you that are newer, you might not have heard the phrases before, or perhaps you have a time or two, but maybe it didn't really mean much to you. Right now, it might mean a little bit more when you hear things like don't fight the Fed and don't fight the trend. Right now, we are still in an intermediate downtrend that has been in place basically since we touched an all-time high in the S&P 500 in the first week of this year. Remember, we haven't even gone past our one-year anniversary of all-time highs in the S&P 500 yet. We have in the NASDAQ, but not quite yet in the S&P 500. And most bearish moments throughout history do not get unwound in under a year. So what we are witnessing right now is more of the expectation compared to historical standards. But it's every moment in time is a little bit different than the next. So you've got to be careful not to compare them too directly. But in general, there's a lot of time that needs to be spent to wipe out the excess and the greed and the fraud and all this kind of stuff that comes with the markets. And of course, we've been talking about Sam Bankman-Fried here recently. And then yesterday on Twitter, some of you might have caught the news on the handle is Mr. Zach Morris. So we had a good chuckle about that in my question and answer session earlier today, talking about that scandal, which was a big pump and dump scandal of a bunch of fellas that were involved in, propping up these garbage stocks only to sell them after they've pumped them up, in many cases at least, and then leaving the public as bag holders. Meanwhile, they drive off in their Lamborghinis. And so this type of behavior needs to stop, right? We need to flush that out of the system before we're ready for that next stretch. A week or so ago, I think I mentioned the concept of burning the forest to the ground in order to clear away the dead brush and reseed the ground for the tree sprouts that will come eventually down the road. But this type of thing does not happen overnight. It is a process, and we are working our way through that process right now. So here's the end result of today. And what I saw on Twitter earlier was someone mentioned that this is what the evaporation of $870 billion looks like right here. So not quite $1 trillion, but nearly $1 trillion wipeout here today in the S&P 500. So there was very few places to hide. There was maybe a couple of little like insurance companies. Progressive did okay. You had a little bit in the way of energy. EOG was up. Believe it or not, Tesla was up, so that one was interesting to say the least. Of course, Tesla has been down most of the days here in recent weeks while the rest of the market is up. So wouldn't you know, on the day when it is discovered that Elon Musk has been selling a whole bunch more shares, Tesla manages to close in the green on a day when the rest of the stock market gets annihilated. Go figure. An old school company like Verizon was up here today. PNC Bank was up a little bit. Who's this? We've got Nordson, which is an industrial company, up a little bit. CCI, Crown Castle, that's the cell phone tower REIT company. It was up a little bit. So there's a few here and there. The other thing I should mention real quick is the home builders did pretty good today. Notice that this little cluster of green shows up here off to the right-hand side where we've got D.R. Horton up over 3%, Lennar up over 3%, NVR up over 2%, and then Pulte up 1.5%. So nice little cluster there for some of the home builders, but that was about it. The rest of it was just an onslaught of selling right out of the gate. I mean, it was a little bit of a gap down to start the day, and then it was just a continued push towards the lows throughout much of the rest of the session. Lots of big stocks taking it across the chin. One of them that stands out to me is Netflix. Notice that Netflix was down about 8 almost 9% here today. It took Disney down with it, down about 4%. Google was down about 4%. Remember, we do have an iron condor on Google, so luckily it wasn't a bullish trade where we get a little bit of an advantage in regards to having our break-even points as wide as they are. But that's one we'll definitely have to keep our eye on as we move forward. A lot of the other stocks just got hammered, and quite frankly, some of our trades have been able to get bailed out a little bit. One that comes to mind, let me see if I can find it, is Goldman Sachs. Some of you may recall that I placed a bearish trade on Goldman Sachs. It was probably a month and a half ago, but it was for the December contracts, and I have not yet traded out of them. And I might very well get bailed out by this move at the end of the week here, because we want that stock to close below 350, and it had gone all the way up to like 380 or something like that. It just kind of blew past what I was expecting, but it has completely round tripped and is in the point now where it's possibly going to be a winning trade for us. I'm going to keep my eye on it tomorrow. Remember, tomorrow is options expiration day. It's quad witching day, and so if you have options contracts out there, make sure you're babysitting your positions tomorrow. In the case of Goldman Sachs, I think that was a bear call spread where our short strike was 350, and you can see how close we are right now. It's at 349.83. So if it would pop up a couple of bucks tomorrow, then I'll be back in the money on that, and I'm going to need to close that down because I don't want to go into the weekend with that closing in the money, because then I'm going to end up having a position that I don't want when it comes to Monday morning. On the other hand, if we have a continuation or a follow through of selling tomorrow in the market, this could go from a situation that was looking like it was going to be a max loss to possibly a max gain, right? And it took a day like today to kind of reset the deck to get some of those trades back in the direction that we wanted them. So perhaps some of you have been bailed out by today as well, and this wasn't quite as ugly as a result, because for a lot of investors, this was a tough pill to swallow. All this red out here, ugly, ugly, ugly across the board. Let's go ahead and pop on over to the main part of the platform, take a look at some of our market breadth numbers now. And let's come over here to the Market Watch tab, and I've got the S&P 500 pulled up at the top here. And as you can see, we've only had 32 stocks in the S&P 500 closing higher today. So that's almost it's right around approximately 6% of the index managed to close in the green, which means that basically 94% of the index closed in the red today. In fact, I'm pretty sure I was just talking about that with you guys on Tuesday when I did the video last, how we've seen a few of these 90% types of days here recently, but that Tuesday was not one of them. It was like a 70% day. Well, today, this is what a 90% day looks like. Again, looking at this this heat map here briefly. That's what 90% to the downside looks like. Sometimes you get 90% to the upside, but this was an onslaught of selling, an overwhelming amount where it was just consistently bearish across the board, regardless of where you were hanging out. Again, really the only exception to that might have been the home builders. Otherwise, you had to get really, really lucky to land on a green square here today. Let's go ahead and pop on over here to the main part of the charts now. And as most of you are aware, whenever we have a move of over 1% on either direction, either the upside or the downside, I like to start with this chart as opposed to our traditional 4-grid view, just because I think this gives us a more interesting way to understand and interpret and visualize what kind of volatility we've been dealing with lately, if any, right? And one of the things that has been kind of interesting about this move lately is that there has been a lack of volatility for the most part. Notice this purple line down below, that effectively measures the VIX. And notice that after kind of topping out back here at the end of September, beginning of October, the VIX just went on this slide lower and lower and lower until here just yesterday, where it reached its lowest point and then popped back up. Kind of interesting the way that the VIX has actually operated this week, because the VIX was actually up a whole bunch on, I think it was Monday, even though the market really wasn't moving much. And then yesterday, when the market got choppy after the interest rate announcement, the market ended up closing lower by like 0.7%. So not a very big day. Yes, it did flush away the gains that were there ahead of time, so there's something to be said for that. But the end result of yesterday's trading was not that egregious. Yet the VIX plunged yesterday and actually hit a new multi-month low. Now today, today you can see volatility and fear coming back into the system. The VIX did bounce back up to about 22 or 23. But for the most part, we are way down on the VIX compared to what the fear was of the marketplace back here at the beginning of October. So that's been kind of interesting to watch this week as well. Here's what this middle part looks like after a big 2% plus down day here today. S&P 500 was down 2.49% when it was all said and done, basically tying the drop that we experienced back here on November 2nd. So this candle right here and this candle or bar over here are basically identical, showing us what that looks like on the charts up above. That's associated with this candle right here and this candle. You'll notice that on that first one, we did have a down day that very next day. So who knows? Maybe we have that tomorrow again. It's going to be a volatile day just because we got options expiring. And it's the end of the week where all of a sudden it feels a little bit more uncomfortable again in the market, and therefore sometimes you'll find that Fridays can be difficult days because a lot of people unload their merchandise right before the weekend because they're fearful of what additional bad news might come out on Saturday and Sunday when the market's not open, and then who knows if there's a gap down on Monday, right? So that type of mindset can enter into the system. I'm not sure if we're quite there yet because, again, the VIX is still pretty low at this point, so I don't think this is like everybody running for the exits. Yes, today was a bad day, but if this was one of those everybody's panicking and pulling their hair out moments, the VIX would be way up here, at least higher than 30. And we're not even there yet. We could get there, but right now it's not the case. So I'm not sure we'll have that type of a day tomorrow, but nonetheless, something to be on the lookout for at a minimum. You'll notice that here recently, more of these kind of larger bars that show up in this middle area have been the green ones to the upside. Right? This has been a rare moment in time in 2022 where we've probably had more green bars up here at higher levels above 2%, like right there, 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 and right there, right? There's been 1, 2, 3, 4, 5, 6, 7, 8 2% plus up days in the market since the first day of October. And we've only had one, so this would have been the first week of October, 1, 2, 3, 4, 5. Today was the 5th. So we've actually had more 2% up days since the beginning of October than 2% down days. And so I think a lot of us felt like we were due for a day like this. This kind of felt like fantasy land as the markets were rebounding off their lows in the fall, where there were a number of portfolios that actually went into the green, including my DGI class account. After today, we're back in the red, but that's the way it goes. It would have been nice to close in the green for the end of the year, but I doubt that's going to be in the cards after a day like today. But that just goes to show you that there were literally some investors out there whose accounts were at all-time highs. Some of my own personal accounts were at all-time highs as recently as last week. And that just felt like la la land. It didn't feel realistic. I didn't feel like I deserved it. It feels like this is a market environment where you shouldn't have that type of success because there's a lot of work to be done when it comes to inflation. And so a day like today, certainly you feel the pain of that. But if you went into it with the right mindset, understanding that you probably didn't deserve all the gains you got in the last couple of months, then it makes a day like today a little bit more easily absorbed. It's also helpful if you have a few bearish positions in your portfolio, as I mentioned before with that, Goldman Sachs trade and some of the others that we've done. And of course, we've done bearish trades in my factor-based swing trading class, and you guys have done plenty of bearish trades with David's class. So I think that helps a little bit on days like today as well. It might not completely soften the blow, but at least it helps just a little bit compared to somebody who's just completely long. And there's probably people out there that aren't only long, but they're leveraged long, and they might be borrowing money to be even more long in the market, and they're really going to get hurt on a day like today. So, we try to look at the markets rationally whenever possible and approach things day by day, understanding what sort of a market we're in and, setting our expectations accordingly. And I don't think you would have found that either David or I were like rah bullish that this market was just going to take off to all-time highs here all of a sudden. I think we've both been quite I wouldn't say pessimistic, more realistic of where we stand with things right now. And therefore, it helps us kind of accept a day like this a little bit better. But without a doubt, it kind of felt like a jolt all of a sudden once again, a kind of a wake-up call. I had mentioned before that it might be helpful for those of you that might have missed my presentation a couple of weeks ago when I had this conversation about the lower highs and lower lows. Maybe it would be good to kind of take a quick look at that here as well. I'm not sure what the best way would be to display this. I kind of want to use monthly. Let me do this. I'm going to come over here to chart 2A, and I'm just going to pull up the S&P 500, SPX. And then I am going to change this from weeks to months. I think it shows up a little bit better on a monthly basis. It still looks kind of the same way weekly, but I think it's just a little bit better when you look at it on a monthly basis because I think it stands out a bit more, or at least it seemed to me. And so, basically the idea of what I was showing people before was, let me get my drawn items out here. Where did we go? There we go. And let me use this trend line tool. And if you were to lay that trend line right across the tops of the highs of this year, it basically matched up right at pretty much 4,100 right here. And that, held almost perfectly the first time it touched it last week. This week was a little bit weird because we had that one day where we had that big gap up, and so we had the high of this month, I guess you would say, that had that gap that pushed us a little bit above 4,100. I can't remember what the high was. This is saying that the high was 4,100 spot 96. I'm not sure if that's accurate. It should be. I don't have any reason to believe it's not. But anyway, that matched up really nicely with that downtrending line. It might not be perfect, but remember, the old saying in technical analysis is draw with a crayon, not with a fine pen. And the reason for that is not everybody will draw the line exactly to the perfect degree. And so if you're kind of looking at it like that, you get the understanding of it a bit more. And if you were to flip this back to just the normal weekly view, it's kind of the same way, right? Yes, again, this week you had a little bit of a higher bounce than maybe some people felt comfortable with, up at 4,100 spot 96, but it was quickly evaporated. Now all of a sudden, notice on our weekly bar, we are basically closing, or at least at this time, at the bottom of this week's range. Of course, we've got one more day left, so we can't put it in the bag right now as though it's closing at the weekly low. But as of this moment in time, I have no reason to believe that it won't. Right? Tomorrow could easily, be another day of selling, and so this has kind of held. It's maybe been a little bit more choppy or rockier than some people felt comfortable with, but in general, this series of lower highs and lower lows is still alive at this moment, and it's responding to that downward trend line as a resistance point quite nicely as well. So, that's the mode that we're in right now, unfortunately, right? This should not have been a big surprise here today. We're due for a sell-off. We're getting it today. And we shall see how we end the year. But there's a pretty decent chance that next year could be a difficult year for stock participants. So just keep that in the back of your mind. And many of you, of course, are well-heeled investors and traders, and you've got a lot of tools in the toolbox to help get you through those more difficult times. And of course, many of you are also premium members of Market Scholars, where you get to work with David and I every single day with our various premium classes as well. And hopefully that generates some interesting ideas for you to pursue at the same time. So anyway, been an interesting day to say the least, but I think for a lot of us, it wasn't completely out of left field that a day like this we were due for. Let's go ahead and get back on over here to our normal charting routine with our 4-grid now. And this is just chart 4B for those of you that are premium members following along with our premium package here. And as you can see, today had a pretty devastating effect on the postures. The postures have been kind of flipping back and forth here recently because you couldn't really get any sort of movement or traction, I guess you would say, right? It felt more like the market was spinning its wheels in the mud here more recently. And when you have a market like that, those are the markets that are more prone to the back and forth posture changes. So just look at like the Russell 2000 as one example. Notice how the background color of the chart is flipping back and forth very regularly. The Dow was the one consistent area, right? In this time period, the Dow stayed bullish the whole time. So that was kind of the oddball of the group, showing us that persistence. But these other charts had healthy amounts of back and forth postures because we just couldn't really get traction within the market. We had that big burst off the lows for a big chunk of October. But once we got kind of into end of November into the beginning of December, it's really just been chopping sideways. Today was a little bit more important in that regard because today felt more important to me. It felt like the market finally made up its mind that it is expecting more difficulties in front of us. Today was a day where we clearly broke through support levels on all 4 of our charts. Let me right click on the S&P 500 and we'll kind of go through these one at a time because sometimes it's harder to see when everything's all scrunched up. So on the S&P 500, we were down 2.49% today. Notice that not only did we break through the moving average, so look at the moving average, color is now yellow. Not only did we see a posture shift on the market forecast where the green line was going up yesterday, now it's going down, so that's why the background color has changed to pink. But in addition to that, you have a horizontal break of support right here as well, because you had these 5 candles that all were kind of bottoming in approximately the same area. Today, not only did we get below the lows of all those candles, but we closed below the lows of all those candles. Remember when I was with you 2 days ago and we were talking about the rarity of that candle right there? The market was up that day, but that was that big gap up day that saw the rest of the day selling off. And I said that's more of a bearish feature when you gap off or gap up and then sell off the rest of the day. And of course, since then, we've now had 2 straight sell-off days, pretty aggressive ones at that. So these last 3 days have not felt comfortable to people who woke up just 2 days ago thinking that we were back to this massive rally into the year end or whatever the thoughts might have been at that time. This has been probably tricky for some people. I'm going to venture to guess that the way that this kind of shaped up here, this probably caught a few people on the wrong side of the trade. I'm going to guess that there were some people that were willing to short the market right here when we were in the midst of that 5-day sell-off. And remember, that started with that overbought cluster signal, still the only one on this chart over the last 3 months. And so we continue to look at that and say, that was noteworthy, right? How valuable is that little dot that shows up on that chart if this is what has allowed you to be bearish on a day like today? But the problem is, after coming down to this upward trending 30-day moving average, some people might have put their stop losses just a hair above this candle, and you'll notice that this candle over here just barely, like by the smallest of margins, took out the high on an intraday basis. The high on this candle was 4100.51. This was 4100.96. So not even 1 point on a 4100 point index is the difference between those two. So I do wonder if some people ended up getting really hosed on that deal. I hope it wasn't a lot of you. Most of you are not going to have that tight of a stop loss, but you never know. Remember, you can't trade the S&P 500 anyway. This is an index. You could trade options on it, but most people are probably not going to get too unwound with that type of a move. Nonetheless, I could envision some people being trapped by that, saying, okay, I'm gonna give my bearish trade some time to work, but if we go back to hit new multi-month highs, then I'm out. And so who knows, maybe there were some automated programs out there that once we top tick that sucker right there, just a touch over that one, maybe a whole bunch of buying orders to basically flattened short positions were sent to the market, and whoever had those orders going out immediately regretted it. And here we are just 3 days later, they could have had an epic bearish trade, and now all of a sudden they're on the outside looking in. So sometimes that kind of goofy stuff can happen, and it's part of the process of what is pushing the market around. And so I found that to be somewhat interesting with this move that we've had lately here as well. So aggressive day to the downside. We've got our red line in the lower reversal zone, but because the green line is no longer considered bullish, we would not call this a bullish intermediate confirmation signal. Again, market was down about 2.5% in this case. Let's look at the Dow now, because the Dow had been holding up the best out of these four major indices here in recent weeks and months. Today, it suffered as well, but is often the case, the Dow generally does not sell off as badly as some of the other indexes when we have a big sell-off day. The reason for that is you have your big blue chip, kind of more well-heeled types of companies in the Dow compared to the more growth and cyclical areas that you find elsewhere. And so it was able to kind of retain a bit more, of its recent gains, but still, it was a bad day for the Dow. It was down 2.25%. And I'll say the same thing about it that I just said with the S&P 500. You not only saw a posture shift from green to pink on the chart because this green line went from going up to now going down. You not only saw a breach of the 30-day moving average, notice the color of the moving average went from green yesterday to yellow today, but you also saw a support break of an important kind of horizontal support area right around, let's call it 33,400 or what have you. And we closed a full 200 points below that today. So again, it was a more emphatic day. We didn't close at the lows of the session, but we closed in the lower half of today's range. So I think today was an important day. It was one where the markets were saying, you know what, we better rethink this whole Fed pivot, this mindset that has been out there here recently. That does not seem to be the legitimate mindset of what is actually going to happen. So it wasn't just some day in passing where we saw a whole bunch of stocks down. This was, to me, it felt like an important day. Let's take a look here now at the next chart, which is the NASDAQ composite. And this one was down quite a bit, 3.23%. And again, that's fairly typical as well. The NASDAQ is, a more speculative index. It's become more quality as the years have gone on, but it still has the reputation of being the place where all of the big tech stocks are housed. And, while there's plenty of excellent tech stocks out there, there's also a bunch of up-and-comers that haven't really proven themselves yet. And those are oftentimes the types of stocks that struggle on days like this. So on risk-off days like we had here today, you should assume that the NASDAQ is typically the worst performer. Either that or the Russell 2000, but usually it's not the Dow. And if that's ever the case, of course, we'll tell you otherwise. But normally, if you're thinking high-level perspective, that is the thing that you want to educate yourself on. So this should not come as a surprise. NASDAQ Composite really got kicked in the teeth here today. Again, I pointed out that very oddball candle to you guys 2 days ago on Tuesday, where we had this filled-in candle that looked like we were going to be off to the races. It tricked a whole bunch of people. Here's another one where you were up and over the highs of that candle and on that candle, but the NASDAQ's been a little bit different because your true high was still way back here 3 months ago. So it wasn't quite the same as the S&P 500, but still people who are more actively trading might have kind of had the same mindset, saying, okay, I'm going to go bearish on the market here with this big sell-off, and if we go back and breach the highs of that candle, then I'm going to flatten my bearish positions, and who knows, maybe they went bullish to compound the matter even worse, and they have just had a headache on their hand for the last 3 days, because ever since basically topping that prior candle, it has been selling, and more selling. Or as the old book this time of year goes, what's that? There's a line in The Grinch that always cracks me up. Stink, stank, stunk, right? Had to read that book to my son the other day as his bedtime story. So stink, stank, stunk. And the Grinch has certainly come over here and poured a bunch of water over what had expected to be a Santa Claus rally for some. And you'll notice here, similar to what we saw with the S&P 500 and the Dow Jones Industrial Average, not only did we see a posture shift where that green line went from going up to going down, so green to pink on the chart, we are now below the uptrending 30-day moving average, so green to yellow on the moving average, and we once again broke an important horizontal support area here. Not only broke it, but closed well below it. A very emphatic day where we closed near the lows of the session. This one also has the red line in the lower reversal zone, but because that green line rolled over, we don't consider it a bullish intermediate confirmation signal. And then last but not least, let's take a look here at the Russell 2000. And this one was not down as much as the NASDAQ. It was only down 2.52%, so a little bit worse than the S&P 500, but not as bad as the NASDAQ. But to be honest with you, I think this chart actually looks worse than the NASDAQ. Notice that you've got that whole stink, stank, stunk phenomenon going on here as well. But with this candle, you close near the lows of today's session, much more so than most of those other indices. So it kind of seemed like if the markets were open for a couple more hours, you probably would have seen even more selling in the Russell 2000. So they were kind of like almost saved by the bell. Again, joking with my premium members in my question and answer session class here today, talking about that whole scandal with, quote, Mr. Zach Morris. I had no idea who this guy was before the last 24 hours. And so my thought initially was saved by the bell for those of you that grew up in a certain era as I did. But little did I know it was actually a huckster on Twitter. So be careful out there. Be careful with who you trust and who you follow and all that kind of stuff. But anyway, in this case, it kind of felt to me like the Russell 2000 was saved by the bell, because had the market continued to be open for a few more hours, I could have envisioned a situation where this thing could have rolled over even harder. And you'll notice here that the Russell 2000's green line is down here at 34, right? You can see that in the label right there. And as I mentioned to you guys on Tuesday, the Russell 2000 is the one of these four charts that I identified on Tuesday as being what I considered to be the laggard, right? I explained my reasons for it at that time, including three red arrows and a number of other things that were going on, including, notice that their moving average is still red, right? That made it different on Tuesday. I specifically pointed that out, where despite this big gap up that we had on Tuesday, we closed below that falling moving average. That seemed very odd with that behavior, and has now led to additional selling the last 2 days as well. So it hasn't made that situation any better. Notice the background color of the chart on this one is that darker shade of pink, because not only is the green line rolling over now, but it's rolling over underneath the 50th percentile, and that means it's even more bearish than on the other charts as well. So while we didn't see as big of a percentage drop today in the Russell 2000, I still look at this chart as being the worst of the bunch here. A very ugly looking rollover that's taken place here in the last, let's call it, couple of months. And that's actually, something we'll talk about here in just a little bit when we get to discuss the factor selector as well. Let's take a look at the three red arrows chart here. I say three red arrows, but technically we call it the three green arrows chart, but I'm sure there won't be any three green arrows here to deal with today. In fact, unlike Tuesday, remember one of the differences on Tuesday was that only the Russell 2000 had three red arrows. The other three had mixes of green and red arrows, and I had mentioned that all it would take was for those other indices to close below their moving average, and then they would go to three red arrows as well. Well, that's exactly what we have in front of us now today, with the benefit, of course, of hindsight, knowing that the markets have been quite ugly the last 2 days after having that fake out move on Tuesday morning. So now you'll notice that we got a red arrow on the moving average there on the S&P 500, a red arrow there on the Dow Jones, and a red arrow right there on the NASDAQ on all of their moving averages, which joins the previous red arrows that had already existed with the MACD histogram and the stochastics on most of those. So fast forward to today. Remember, Tuesday, only one of these four charts had three red arrows. Today, because of the epic selling we've had in between, all four of our charts are now in three red arrows status. Let's go ahead and now pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support this presentation. Remember, it is free of charge for you. We hope to deliver good commentary. We won't be perfect, just like nobody is, but hopefully you will get some good insight from listening to our presentations. And if you do, we ask one simple request out of you. Just simply click like for us there on Twitter. That's the easiest way for you to say thank you to us. And as I always say, as long as we're up and over 100 likes, I'm more than happy to give you a full-length video the next time I'm scheduled to do it. Today I had to kind of rearrange my schedule in order to get this done because, as I mentioned earlier, I've got to go to my son's school Christmas concert here tonight. And so I had to kind of hurry things up in a way that I don't prefer. But because I respect you guys and your time and want to get this to you guys as quickly as possible, I'm trying my best to hurry this through and get it out to you guys earlier here today, as opposed to waiting until coming back late tonight after the concert and doing it for you. So if you appreciate the effort that I put into it and being thoughtful enough to try to get this out to you at an acceptable time, the one way that you can thank me, and the best way that you can thank me, is simply clicking like for me there on Twitter. And as long as we're up and over 100 likes by the time I'm scheduled to do the video again on Tuesday, I'll be more than happy to give you a full-length video like I am doing for you at this exact moment in time. On the other hand, if you're getting kind of sick of these hour-long presentations that I give you, I understand that as well. If you would prefer a 15-minute video that only covers the 4 major equity indices and does not get into the 12 grid analysis and a trade application example, if that fits your mindset, then don't click like. Don't support the video. Just sit there, listen to it, and if we're under 100 likes by the time I'm scheduled to do it on Tuesday, then I'll plan on just doing a quick 15-minute video. So I let you guys decide collectively. Do you appreciate the 3 hours that David and I put into these videos on a daily basis? If so, we don't think it's too much to ask out of you to simply click a button for us. For some of you, maybe that's hard, but for others, I think you're kind of getting into the routine of doing that and understand that it's a good way to help support us and our efforts and our time that we commit to these. So let's do some shout outs here. Thank you to T-Fib, thank you to Tom, thank you to Al, thank you to David, and thank you to Paul, HR, Tom, Floyd, Brandon, Tim, Sonia, Paul, Teddy, Boss, and Phil, and Deviant, and Ayakipa, Vodacon, Valerie, Roger, Greg, Scott, Carl, Gerald. We've got Kirk and Nietzsche and Dave and Sheila and Ray and Zekuf and everybody else. I can't get to all of you, but I do like to give you your moment in the spotlight every so often, just to acknowledge you and let you know that I appreciate each one of you that take the 5 seconds out of your day to help us along with that. All right, let's go ahead and take a look here now at some of the stuff that we've been working on at Market Scholars today. Of course, Thursdays are the days that I do my question and answer session for my premium members. Remember, David and I each teach 5 premium classes during the week, and our final class of the week is what we call a question and answer session, where we kind of circle back to some of the concepts that we were working on in our 4 trading rooms earlier in the week and make sure we're helping tighten up those concepts for our students. And so it's a way for our premium members to work more directly with both of us. So today we talked about dividend growth investing with Amgen and whether it made sense to look for it as a regular DGI trade, or would it make more sense to sell a put on Amgen? And if so, which strike prices should we concentrate our efforts on? I also got a question on MTB, a bank company that some of my dividend growth investing students have been familiar with simply because we used to own a company called People's Bank, which used to be a dividend aristocrat. And then a few years ago, it was bought out by MTB, and MTB itself finally made its way onto the CCC spreadsheet this year with 5 years in a row of increases. And so maybe we'll end up talking about that company a bit more, but that stock has been down significantly in the last couple of weeks and now is back kind of in that blue zone, more attractive territory that we like to look for. So it would not have been a buy 2 weeks ago, but as of right now, it does have some very interesting elements associated with it. And then I got a question about using the Analyze tab on Thinkorswim and specifically the probability analysis. Spent some time working with the probability of expiring cone, helping students kind of understand those tools a little bit better, understanding things like 1 standard deviation moves and how to set our expectations appropriately around the current trading plan that we use in my Options for Long-Term Investors class. I did get a question about how to turn off some of the various think scripts that I have on some of my charts, including the dividend stair-step chart. And then I also got a question about, the thought process on timing when it comes comes to buying dividend growth stocks for the long term, and whether we want to try to time the tops and the bottoms, or do we want to try to our best to find stocks that are trading at appropriate valuations and ride through the storm. So I had a lot of thoughts to share on that topic, as I'm sure many of you can imagine, given my passion around dividend growth investing. David taught his portfolio management with ETFs trading room here today, and so feel free to check out those recordings on our website if you are a premium member. Let's also talk about our factor selector tool. A reminder that this gets updated on Tuesday evenings, and so it would not have included any of the selling that took place yesterday or today. So this might be a little bit different, but that will be included in next week's update. So I produced this on Tuesday night for the benefit of my Wednesday morning factor-based swing trading class. Remember that factor-based swing trading class is one area where we can do bearish trades with my particular trading rooms. David does a lot more bearish trades, but my trading rooms tend to be more longer term. So mine tend to focus more on going long the stock market. But that class on Wednesday mornings is where the class, like they did yesterday, can vote for bearish trades if they want, where we practice on short selling techniques in the short term. So we use this factor selector tool to help guide what types of companies we want to focus on either the upside or the downside. And there really wasn't much to share with you guys this week because we really only had one switch. In the 4-5 position, momentum and value just flip-flopped from one another. Oil had been suffering to a degree, and I think that is kind of the story as to why value has been kind of suffering in the last few weeks. Other than that, we do have low volatility remaining number one for the second straight week. Remember, interest rates have actually rolled over nicely, at least on the long end of the curve, and that has helped support interest rate sensitive areas like utilities and REITs. And if you can think of any stock that represents a low volatility conversation, it typically is utilities and REITs. So that has kind of aided them on a comparative basis here more recently. On the flip side, we do have low size at the bottom of the graphic for the third straight week. And low size, remember, is not really getting any sort of a benefit from the falling dollar, whereas the other factors have lots of large cap companies in them that do business elsewhere. They have a slight benefit when it comes to that type of an environment. And for the last couple of months, we've been in a falling US dollar environment, and that really has not helped support the low size category there. All right, let's go ahead and pop back on over here to the Thinkorswim paper money platform, and let's go through some more 12 grid analysis now. Let's start with chart 5A. And as you can see here, we've got lots of green and pink charts showing up here. A reminder that the pink background charts are going to be those that have a bearish intermediate posture according to the market forecast technical indicator. And then on the green charts, those of course are going to be those that are more of the bullish variety in terms of the posture setting mechanism of the market forecast. So let's go through them. Let's start with the bottom two corners, as we often have in my presentations this year, because those have been some of the drivers of the market. We did have a day where the US dollar spiked pretty nicely. It was up about 1% here today. Obviously, it remains in a downtrend. It actually just had an oversold cluster signal yesterday. So this could be part of just a quick little dead cat bounce. Who knows? Then again, if the stock market starts rolling over in a big way, I could also envision that the US dollar could very well become a safe haven type of an asset once again, like it was earlier in the year. So let's keep our eye on that theme. But for right now, it was up nicely today, but remains in a downtrend with a bearish posture. TNX is a little bit different. As I mentioned here just a moment ago when we were talking about interest rate sensitivity with low volatility stocks, TNX was actually down today. Can you imagine? I mean, earlier this year, we were in a situation where it was the TNX going up that was causing the stock market to go down. So this was very goofy today to see both of them down together. Very strange indeed. Remember that the Fed does not control the long end of the curve. They do control the short end of the curve. So what you're finding is that we are in a heavily inverted yield curve environment where the short end of the curve is well above 4% yields at this point. But if you go out 10 years, you can see that the interest rate is at 3.45%. And remember, we were just at 4.33% here back in October. So we have slipped quite a long ways, almost 90 basis points there, and that is a dramatic amount in such a short amount of time. So it's it's going to be interesting to see how this resolves itself. But right now there's a conflict going on where Jay Powell is controlling the short end and he's doing what he wants with that, but he can't control the long end. That is being dictated by market forces. And right now market participants are willing to buy U.S. government bonds, perhaps because they view it as a little bit of a safe haven asset. If the stock market starts getting, punched in the gut, then maybe bonds can actually catch a bid in 2023. Remember, that's what's made 2022 so odd. Not only has this been a bad year for the stock market, but it's been a horrible year for the bond market. That is not normal. So next year, maybe we get back to normal. Next year, maybe we have a falling stock market for most of the year, but the bond market actually stabilizes and goes higher. And if that happens, remember that helps the buying pressure of long-term bonds themselves, which basically puts a lid on long-term interest rates. So it's a little bit of a funky phenomenon that's taking place there, but perhaps that's kind of what's going on behind the scenes. Nonetheless, TNX does remain with a strongly bearish posture. It's below its falling 30-day moving average. And, the flip side of that is that U.S. government bonds remain in their bullish posture from a price perspective and above their rising 30-day moving average. You will notice that the long-term U.S. government bonds were up today, not by much, but by 0.13%. However, the foreign bonds and high-yield bonds both sold off today. Now remember, foreign bonds probably had an embedded negative aspect simply because the U.S. dollar was up. So that might have played a role right there. And then with the high-yield bonds, they were down about 0.9% today. Remember, that's more of a phenomenon of risk off versus risk on. The sketchiest companies out there are the ones that have junk bonds or have raised high yield debt. And so on a day like today, where the worst of the worst offenders out there, the sketchiest of companies are getting crushed the most, it's a day where there's more question marks in the high yield bond universe. And I don't want to make too much of it because despite this second straight day of selling for high yield bonds, we still remain in an uptrend with a bullish posture here. So that was kind of interesting. Notice that gold and oil were both down today. So they kind of had the more traditional commodity roles here today. With the US dollar up, all else being equal, we do expect commodities to go lower. Gold was down 1.6%. USO, which represents oil, was down 1.8% here today. And it kind of looks like after this 4-day rally on oil, it could very well start rolling over once again. With gold, I have a little bit more hope that it can hold these gains because we're clearly trading above that rising moving average. With oil, it has breached it so egregiously that, it's going to take an effort just to get back to the moving average. And if it can get there, it probably will have expended most of its effort and energy, and therefore then the sellers can take over and push it back down once again. So I'm going to be very curious to see how that relationship shakes out in 2023. But I'm on Team Gold at this moment in regards to the two of them, and it's going to be interesting to witness what actually comes of this kind of strange activity between these two commodities at this moment. Notice that Bitcoin was down quite a bit. It closed closer to 17,000 here today. Remember on Tuesday when I was with you, it was closer to 18,000, and it was reacting positively to the gap up that the stock market had that day. And I was mentioning how Bitcoin is basically a risk-on asset. Well, here's more proof in the pudding. Today was definitely a risk-off day for most market assets out there, and Bitcoin was down over 2%. And it's not a very good look when you get back up to that falling 30-day moving average and then roll over with a 2% loss. It's giving you the impression that there's just not a whole lot of oomph behind this move off the lows, and you fear that this will lead to further selling moving forward. On the top rung here, we of course had plenty of selling up there as well. Notice that the foreign markets suffered just as badly as the U.S. markets here today, especially since the U.S. dollar was up today. So EFA was down 2.55%, and EEM was, I'm sorry, did I say that wrong? EFA was down 2.55%, and EEM was down 2.31%. So both of them down pretty much as much as the S&P 500. So you really couldn't get out of the difficult stock selling even if you started approaching overseas types of assets. Now, of the two, I think it's worth pointing out that EEM has now breached its 30-day moving average. Notice the 30-day moving average has changed from green to yellow. Over here on EFA, it remains with a green moving average. So in other words, EFA seems to be asserting itself in more of a leadership role at this moment, and EEM is kind of just being blown around with the wind at this moment. EEM is very much pushed around by Chinese stocks, a reminder there, whereas I think EFA is a bit more diversified across countries. So that seems to be the place that if you're still looking for bullishness out of foreign securities, that EFA seems to be a little bit stronger at this moment in time. Let's go ahead and take a look here at our sectors. And as you can see, we've got a lot more pink charts on the board all of a sudden. So all it takes is a couple of heavy selling days to change those postures from bullish back to bearish. One thing I will say is that energy actually flipped back to a weekly bullish posture. Remember, on Tuesday I was with you, it was in that bearish posture. So we did have enough kind of stabilization in energy where we've kind of flipped postures positively, surprisingly, on a day like today. Notice that energy was only down 0.61% today. That might have actually been the best performer. Let me check. Yeah, it was. That was actually better performer than some of the quiet sectors like utilities and what have you. So energy was today's leader. It was still down because all 11 sectors were down, but it was down the least amount, only 0.61%. The worst performing sector today was probably communications. Let's just double check. Yeah, it looks like it was. Communications was down 3.9%. Remember, Netflix was one of the worst performers in the market today, and that is a communications stock. So that probably added a lot to that selling right there. It's really the bottom rung that is in the dark green shading. And remember, that bottom rung is set on purpose because those are your more defensive sectors, right? Healthcare, staples, utilities, real estate are much more defensive than these other cyclical and growth compounding sectors above it. So this is another way to identify that we are in the midst of a transition into more of a risk-off mindset once again, because it's the defensive areas that are holding up, whereas the more cyclical areas up above have been switching back to their bearish postures here all of a sudden. All right, let's go ahead and do our trade application example now. And for that, I'm going to pull up chart 2A. This is our dividend stair-step chart that we use for my DGI classes. And I'm going to pull up ticker symbol TSN. Whoops, not TXN, TS as in Sam N. That's Tyson Foods. And as most of you are aware, if you've been listening to me for any length of time over the months and years, I like to sell puts on days when the stock market is down by more than 1%. I get a slight edge when I'm willing to do that because volatility is up and your premium is getting juiced on those days, but the critical element is whether you're willing to take ownership of the stock that you're selling puts on. For those of you that are newer to options trading, just be aware that when you buy puts, you want stocks to go lower. When you sell puts, you actually want them to kind of stabilize or at least not collapse lower. And so that's kind of the mindset that I took today. And I've been patiently waiting for this moment. As most of you know, earlier this year, my go-to strategy for you guys in this very video was selling puts. And the reason for that is we had lots of 1% down days earlier this year. But you've probably noticed that we've had a dearth of opportunities here in the last couple of months. You've been probably wondering why in the world is Brandon not bringing us very many sold puts? He's always saying how he loves them. I do. It's just that I have to wait like a lion in the tall grass waiting for the gazelle to come by. And finally that gazelle is coming by, right? Today is one of those violent days to the downside where you want to strike and take action upon that. So with Tyson Foods, this is obviously quite of a boring company, part of the consumer staples area. It sells meat products here in the United States and abroad. And obviously is a company that probably is going to be able to maintain some sort of semblance of dignity compared to other sketchier areas of the market because, as the old saying goes, you got to eat, right? right? Regardless of what the economic conditions are, you're going to have to buy some food to eat. And people are still going to go to the grocery store and buy, frozen chicken and things like that. So this is something that probably will not get destroyed the way that, let's say, a software company might if the market does go into a really sketchy recession type of a situation next year. But the real reason why I selected this one as opposed to an endless amount of other consumer staples that I could have chosen today is this one is giving us an oversold cluster signal on a weekly candle chart. So this little green dot is showing up underneath the price candle here today. And so that's telling us that there's been heavy selling, and hopefully that is getting closer to a bottom. The other thing that caught my eye with this one is that it now has a 3% dividend yield. A lot of times I look for that 3% yield level in order to start sniffing around for longer term opportunity. And Tyson Foods, as you can see with this kind of thin yellow line here, rarely has a 3% yield. It had it briefly back here in 2020, and then it had it basically right now, and that's it. The rest of this 10-year chart, it was trading above that yellow stair-step line. And so this is a rare moment where Tyson already has a 3% yield. And if we were to get filled by taking ownership of this stock at the strike price that I sold, which was the 55 strike in the month of February. Remember, I did the trade while the market was open and sent out all those notifications to our premium members via Telegram. So make sure you check that out if you need to see the fill prices and all that. But I sold the 55 strike, getting approximately, let's call it 1.3% return on risk. And if the stock did fall all the way down to 55, you would have some healthy support at that 55 level from where Tyson was trading on multiple occasions before bouncing back in 2020. So you get a little bit of technical support there. You've got some information here that suggests this is a fairly rare time to lock down a pretty high yield for this particular company. And you also have an oversold cluster to boot. So number of things kind of aligning themselves for this particular trade setup. Okay, so that's what I had for you here today. Again, I appreciate you checking it out on this very important day where we saw a lot of posture shifts back to bearish all of a sudden once again. If you got benefit out of listening to my analysis, I ask one simple request out of you. It doesn't cost you a penny. It just takes 5 seconds of your time. Click like for me there on Twitter. As long as we're up and over 100 likes, by the time I'm scheduled to do the video on Tuesday, I'll give you another full-length video just like this one. If we're under 100 likes, then we can just keep it at a nice 15-minute variety. So I'll let you guys decide there. Regardless of what you do decide, I appreciate you checking out tonight's video. I wish you well this weekend. If the rest of you parents out there have your holiday concerts coming up here soon like I do tonight, enjoy that time with your young ones. It's that time of year to really kind of embrace that mood, right? So best of success with your trades and your investments. Goodbye for now.